Today, I'm going to show you a step-by-step system on how to properly and practically pick a stock, a winning stock, with real tools, real numbers, and zero fluff. We'll use Apple and Nvidia as real live examples on what you should look for. Now, as a quick disclaimer, this is not financial advice. This video is for entertainment purposes only, and I am not a financial advisor. However, by the end of this video, you'll have all the tools you need to be able to pick what is most likely a great stock. In case you're new, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada, and I've been investing for over 20 years now, so I think it's safe to say I know my stuff. When most people go in and start looking at stocks and ticker symbols, they don't really know. Is this a good price? Is this bad? What do I look for? I get it. You just want to pick something that's most likely going to appreciate in value and not tank a week after you buy it. Step one, of course, research and understand the business. Be able to explain it to a 12-year-old. Now, I'm not saying pour over hours and hours, days of research, but you should have a genuine familiarity with what the company does and how it operates. Don't just go with, well, my neighbor Bob said it was a good stock.
No.
Apple makes iPhones, produces Mac computers, has Apple Music and Apple stores. It's in the hardware and software ecosystem. Nvidia designs GPUs, data chips, that are used to power AI, gaming, and data centers. Why it matters. Apple, for example, has been around longer, is more stable, but has slower growth. B2B tech, Nvidia, well, it hasn't been around as long, so there's higher growth potential, however, is more volatile and depends more on consumer spending. A quick tip. If you can't summarize what the company does in just a few sentences, don't buy it. If it's overly complex and you don't understand it, it just isn't worth the risk. One good thing to look at is each company produces what's called an annual report. Try reading through that if you can. Step two, check the competition moat. So what is a moat? Well, think of it like a castle. It protects a company or acts as a defense from other competitors. How easy is it for other people to get into the industry? I used to work in the oil and gas company, so think of it that way. Not everybody has a few $100 million laying around to invest in the capital, refineries, pipelines, all of these things to run a big oil company. Number one is brand power. Many people will pay a premium for the logo. Think of Heinz ketchup. Number two, network effects. How many users does it have, or people that are familiar with the platform? Think of Facebook, Amazon, etc. Number three, cost advantages. Can this company produce something cheaper and faster than other companies? Number four, switching costs. Is it easy just to switch from one supplier to another? Think of maybe your utility company or companies such as Adobe, which, by the way, is experiencing a little bit of turbulence, we'll say, with their stock. Number five, patents and IDs. Does it hold specific patents to exclusive technology? So if you think hard about it, you're already familiar with dominant players in key sectors and industries. Like you know them. Everybody knows this company or that one because it's so recognizable. A quick side note, this is brand recognition. My set of twins, they have tablets made by Samsung, but they instinctively call them iPads. Dad, I got an iPad. I'm like, is it made by Apple? Well, no, Samsung. Yeah. Then it's not an iPad, it's a tablet. But Apple has a foothold in that industry so heavily, kids instinctively just call it an iPad or iPhone. It's like, it's not an iPhone. Brand recognition. Number three, revenue and growth trends. So if you go on to many of these websites, I'll list some down below. Are you seeing consistent growth, right? Hopefully it's not trending downwards. Consistent, stable, and reliable growth, what you want, should be around 10 to 20% every year. That's healthy. As of late 2024, Apple's growth is around 5 to 10%. Now, that's not really a red flag because they've been around for, 30 plus years? So they're very stable. We all know this. They're one of the largest companies in the whole world, so it's not a red flag. However, if you start to see a steady decline in revenue growth and earnings, That is a red flag. Over the past few years, I'm sure you've heard about Nvidia's remarkable growth, right? The real question is this growth going to continue, or is it just a short-term boom? You could look at how diversified a company is. Nvidia is heavily invested into GPUs. It's about 80% of their business. However, Apple, which is more established, is more diversified, so it's considered less risky. However, Nvidia's risk, putting almost all its eggs in one basket, could pay off. And both companies are leaning heavily on AI development. Who knows? Time will tell. In case you're new to my channel, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I talk about personal finance, investing, and investment portfolios. This stuff that I'm talking about right here, this is absolutely what I love to talk about. I find it very interesting. So if this all sounds like something you'd be interested in, consider subscribing to my channel. Otherwise, like I said, I'm Canadian. I might just have to run you over with my Zamboni. Just kidding. Sort of. Step 4, profitability and margins. This is the stuff that is usually calculated by accountants. So gross margin is revenue minus cost of goods sold divided by revenue. This shows the pricing power. For tech companies, 40+% is good, 60+% is excellent. Number 2, operating margin. Operating income divided by revenue. This shows the operating efficiency. If it's 20+%, this is good for a tech company. Number 3, the net margin. Net income divided by revenue. This is the bottom line and what's left over after paying off all of the expenses. 15+% is good. And so you know if it's a negative number,
that's bad.
If you go on to say Yahoo Finance and you go to ticker, financials, and then income statement, you can see a lot of this data and ratios. Apple's gross margin for reference is about 43 to 45%. Why? Because it can afford to charge a premium on its hardware and services due to brand recognition. Nvidia's gross margin is between 70 to 75% about. And why it's so high is because they are very specialized. There's not much competition out there, so they can afford to charge a premium on their products. The return on equity, or ROE, is net income divided by shareholders' equity. And what this does is say, how profitable is a company? How much profit is it actually making for every $1 invested by shareholders? If you want to find this ratio, you'd go to Yahoo Finance, Statistics, and then it's under ROE. So what is a good ROE? 15+% is good, 20+% is excellent, and 30+% is remarkable. It's outstanding. For reference, Apple's ROE is currently 150%. However, this is due to share buybacks. Nvidia's ROE is currently 100%, which is excellent. If you see a negative or declining ROE, this is definitely a red flag and a signal that the company isn't doing very well. Okay, step 5, the valuation metrics, the big ones. I was going to just read off what's on this chart, but that makes no sense, as you guys can see it for yourself. So I'll just give you a summary of why you would care about each one of these ratios and what it tells a new investor. So to begin with, number 1, the PE ratio, price to earnings ratio. This tells you how much you're paying for every dollar of profit a company makes. Basically, it shows if a stock is cheap or expensive. Generally, under 20 is considered cheap, 20 to 30 is fair, and above 30 might be expensive, but always compare it to similar companies in the same industry because a tech stock will naturally have a higher PE than, say, a utility company. Number 2, the forward PE ratio. The forward PE is similar, but instead of looking at last year's earnings, it uses analyst estimates for next year's profits, which gives you a glimpse into whether the market thinks this company is going to grow. If there's a big gap between the current PE and the forward PE, that usually means investors are betting on major growth ahead. Number 3 is the PEG ratio. The PEG ratio is my personal favorite because it adjusts the PE for how fast the company is actually growing. It answers the question, am I paying a fair price for the growth I'm getting? Under 1 typically means you're getting a bargain. 1 to 2 is fair, and above 2 means you might be overpaying for the growth you're expecting. Number 4, the price to sales ratio. Price to sales is especially useful for younger companies that aren't profitable yet because it shows what you're paying relative to the revenue instead of profits. For tech companies, under 3 is usually reasonable, but anything over 10 means you're paying a premium and betting heavily on future profitability. Number 5 is a mouthful, but EBITDA, or EBITDA. You'll often hear that when people talk about this, the EBITDA ratio. I know, silly. The EBITDA is a more sophisticated metric that's better than PE when comparing companies with different amounts of debt because it looks at the entire enterprise value and strips out accounting decisions like depreciation. This gives you a cleaner picture of what you're really paying for the company's core earning power, regardless of how it's financed. I'll put up some ratios now on the side and you can look at them at your leisure, but this is the forward, trailing, and PEGs. And I'll give you the relative context relative to Apple and Nvidia so you kind of know and understand what to look for. Basically, you can interpret Apple's ratios as stable, but not explosive growth. It's built for stability and reliable earnings. This is due to their brand recognition. However, Nvidia, on the other hand, does have explosive growth, but the question is this sustainable? My current interpretation of Nvidia is that their PE is very high. However, if earnings continue and growth continues like it has in the past, well, the PE could be reasonable after all. However, never ever judge a company solely based on their PE rate, as it depends on so many other factors. It depends on the company's prior track record and PE earnings. Also, on the industry standard and what other companies have for a PE ratio, and also that company's growth rate. As you'll see, Apple's growth is more steady and reliable, as I've touched on, and Nvidia's is more explosive. Step 6, cash flow and balance sheet. Something else created by accountants. Now, accounting can often trick people into false numbers sometimes. However, cash flow is a lot harder to fake and manipulate. Number 1, there's the free cash flow formula, which is operating cash flow minus capital expenditures. You can find this under Yahoo Finance Cash. Why this is good? If the FCF is growing faster than revenue, this is an efficient business. Number 2, cash and debt. You can find this under Yahoo Finance Balance Sheet. The net debt is the total debt minus cash. Apple, for example, has anywhere from $60 to $70 billion in cash. So it has a stockpile of cash that can handle and weather any economic downturn. It does have some debt, but this can easily be covered by their cash. Nvidia, on the other hand, has strong cash flow generation and minimal debt. The result is that it can invest aggressively into R&D with minimal worry. The current ratio, number 3, this is a popular one, and it's current assets over current liabilities. 1.5 and over signals financial health. 1 or below can indicate that the company might be experiencing some problems. Number 4, the debt to equity ratio. Less than 0.5 indicates safer and conservative. 0.5 to 1 indicates a moderate level of risk, and greater than 2 means that that company is highly leveraged and it could be risky. Step 7, growth, quality, and stability. So is the company diversified and has multiple streams of income like we've seen from Apple? Well, it is diversified. It has many streams, which is good. However, Nvidia is more concentrated, which is riskier and might not pay off if AI development is slow. Number 2, operating margins. As the company grows and expands, is its margins getting wider or more narrow? Wider is good and what you want because it's starting to increase its profit. More narrow indicates that they might be having growth and development problems. Number 3, and this is the part that many people miss, are these one-time charges, events, expenses, whatever? Or is this a reoccurring development or ongoing thing? Such as if the company sold off a major division, well, of course, you'll see a spike in revenue, but that won't happen all the time. So This is normally in the footnotes, and it does require a bit of investigation. I know it's a pain, but...
Do it. Do it now.
Step 8, management and capital allocation. So one of the big things is to look at the CEO of that company. How long have they been CEO? What's their track record? Has the company performed better since they took over? Have they kept their promises that they made to their shareholders? So where do you check this stuff? Well, you could go to, say, Wikipedia, and they'll have a disclaimer on that CEO's performance, a summary of it. Or you could go to Yahoo Finance profile, and then key executives, and this will give you a rundown on how they've been performing. Number 2 is inside ownership, meaning do the top executives actually hold a significant amount of stock in that company? I'll put up the stats right here for you to look at, but if they do, that shows that they believe in that company's future. If they hold less than 1%, well, this is kind of risky because they're not really seeing that company as going places. Number 3 is the capital allocation history. What does the company actually do with the profits that it makes? Does it buy back shares? Does it invest into R&D? Does it pay out dividends? What does it do with the money it's generating? Where to check this? Yahoo Finance /statistics/share statistics. Apple, for example, has a massive buyback plan that it buys back shares annually, billions of dollars from its shareholders. It also pays out a healthy dividend. It's a mature company returning cash to its shareholders. Nvidia, on the other hand, is investing into R&D heavily. It does a modest buyback, but is concentrating its focus on future growth. So what to listen for when the CEO is talking? Are they honest about the challenges that they're facing as a company? Does the CEO speak clearly about the company's strategy, or does he try to dodge tough questions? Step 9, catalysts and risks. So events. What could make the stock go up? Is that company or industry as a whole starting to take off, or maybe starting to plateau? What's in the news or upcoming events? Look at Apple. Is there a new iPhone coming out? Some revolutionary technology? Is there some cutting edge development that's being announced almost everywhere? For Apple, is there an expansion into new categories such as VR or AR? Nvidia catalysts. Is there a new development in AI technology? Is it starting to boom or slow? Is there an expansion or explosion in new data centers? Some risks for Apple that you might not necessarily think about right away is, well, it's heavily reliant on China for manufacturing. Also, are there slower iPhone upgrade cycles? Some risk factors for Nvidia could be, well, is the AI boom starting to slow? Is AMD, Intel, and other chip manufacturers getting better or making new developments that could compete with Nvidia? Is, well, China starting to refuse shipment of their goods and imports? Something to think about. If you're into quick research like I am in summaries, you can go onto these AI platforms such as ChatGPT, Perplexity, Google Gemini, and just simply type in, give me a summary of all recent news, headlines, and developments within the last few months. And you can get a quick rundown so you're not sitting there for hours. No one wants to do that. And look at all the recent headlines for these companies or whatever company you're considering investing in. Step 10, decision framework and position sizing. A buy now would be, well, it meets all of this criteria and I can check every box. I totally understand the company and it looks like it's going to continue to be profitable and expand. The watch list would be, well, it's a good company, but I feel like looking at these ratios and headlines, it could be overpriced. I'll put it on my watch list, so if it goes down in value, I might consider buying it. Or does it go onto the pass list? It's too complex, I don't understand anything of what this company's doing, or I assess it as risky. So you know what, it's a pass. Or on the short/avoid list, that it's deteriorating, it's in its declining phase, and you know what, I'm not even gonna take a chance. There's no way in heck that I'm investing my hard-earned money into this company. I want to steer clear of it completely. A great financial tip for pro investors and something younger investors should adopt is never make your portfolio more than 5% of any one particular stock. Why? If it goes to zero, well, sorry, but you've only lost 5% of your portfolio, not your entire life savings. Split it into sections, say thirds. Buy a third now, buy a third if it dips 10%, and buy another third into the future, similar to dollar cost averaging. Also, you may have heard Warren Buffett talk about margin of safety. This is the margin between the value and the price. You always want to be sure that you have a safe margin between those two factors. Another simple rule is if the PE is 50% higher than the historical average, it could be overpriced and you might be better off waiting. For reference, Apple's historical PE has been 20 and currently its PE is 35. In case we haven't met, like I said, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. Subscribing to this channel isn't going to get you financial freedom like so many other content creators promise. However, if you want honest, transparent, informative, and I hope somewhat entertaining videos on personal finance and investing, consider subscribing to this channel. So that's a wrap. I hope you got something out of this 10-step checklist. Like I said, I usually come out with videos every week, and if you're interested in more videos about personal finance and investing, here's 2 great ones you should check out.